your financial advisor is likely missing the most important part of your financial life, fundamentally, completely missing what actually matters most, your business. For the last decade, I have helped hundreds of businesses, 5 million in revenue to 500 million in revenue, and they all tell me the same thing. My advisor doesn't talk about my business unless I'm gonna sell it, and then they care, or they won't give me advice about my business, let alone tax. And they're usually right, because we almost always will ask, has your advisor asked for your business org docs? Have they asked for your tax returns? Have they asked for your financial statements? And the answer is almost always no. That's where we find some of the biggest value add opportunities for clients. We have found tens of thousands of dollars of little nuggets going deep into those areas. So in this video, I'm going to explain why your advisor likely isn't asking you about these things. We're going to talk about goals. We're going to talk about what they should be asking for, the documents they should be asking for, and a fun little case study at the end. So let's get started. Why your advisor is likely not asking about your business and even your taxes is not because they're lazy or incompetent, but how they're compensated and their compliance department usually restricts them. Most advisors are just paid the traditional AUM 1%, assets under management. Well, kind of hard to assets under management a business. It's an illiquid asset. There's not a way for the advisor to manage it. That actually goes same with real estate. And so you find that advisors don't generally talk about businesses or even real estate with their clients. The other reason is compliance. Their compliance departments are very rigid. They say you can't talk about real estate. You can't talk about taxes. We find that to be a huge miss. There's so much opportunity in that. Unfortunately, that does create a negative bias against those things. We've heard people even complain about comments made such as, you should sell your real estate and just put it all in the stock market. That's not good advice. It's missing who you are and your circumstances. So let's dive into what your advisor should be asking you, what they should be talking about. And that always starts with goals. Fundamentally, what are you trying to build personally and what do you want to do with your business? What is your business going to look like over the next 5 to 10 years as a wealth mechanism, the wealth mechanism on your balance sheet? So I'm going to walk you through 3 common scenarios we see with clients and how we think about them a bit differently so that you can understand it's nuanced. It's about you. It's about personalizing what you want in your financial plan and in your business and not just call me when you're ready to sell it. So let's dive into it. This is a framework that we've built, and scenario 1 is a common one of we're going to exit in 5 years. So in 5 years, we are wanting to get out. We're trying to get the most amount of value and pay the least amount of taxes. That is at the heart of what that scenario looks like. Now, scenario 2 is keep it in the family. A ton of family businesses in this country, and that's what they've been executing on. Now, estate planning and asset protection and cash flow become a lot more important as, mom and dad were relying on their income to now flow into retirement to fund a retirement, and they need to be able to spit out cash flow. So we're looking at a number of items there. Now, what's interesting, one that's becoming more and more popular is what we call the chairman of the board scenario. That's where you are trying to build a business that you're going to keep, but be operationally independent from. That is a different build out. Yes, value matters, but what matters the most is, do we have the right team that can produce steady and predictable cash flows so that you don't have to be there every day? Most businesses are really stuck on their owner. They need their owner. And so we're really focused on more of their personal wealth building and using that wealth engine that this business is to really drive the rest of their personal goals. So there's so many other scenarios. That's why the question has to be asked, what are you trying to build and what do you want your business to do? That has to be asked. From there, that's going to guide what the focus is of the planning relationship. So let's talk about the things that your advisor should be asking. There's really 5 set of documents that your advisor should be asking for to be able to best advise you as a business owner. Number 1 is your business financial statements. That is the cornerstone. If we don't have that, we don't have any. We have to know the balance sheet and the profit and loss, the income statement. That is where we start. Then we go to the business tax return. Now, the business tax return coupled with the financial statements is where a lot of little gems, hidden gems come out. There's a lot of optimizations that we can find because how your entity is structured, how you pay yourself, all of those things start to present a lot of opportunities. Third thing, very critical, probably the most missed, is business organization docs. That could be your operating agreement, buy-sell agreements. Buy-sell agreements is probably the most missed. What does that thing say? How is it funded? Who's this business going to? Is it in conflict with their estate plan? There are so many scenarios we'll find. They'll want the business left to someone through their estate plan and everything else goes to someone else. But their buy-sell agreement says their partners get the business. So now we have a conflict. Who's actually going to get that business? Well, by the way, the buy-sell agreement would supersede. So that's why we need to know what that thing says. Fourth, probably the one that the owners have the least is a business valuation. Most of the time, it's uncommon that we find they have a valuation outside of their CPA maybe doing one. That's obviously where value maximization starts to kick in. What we're building this thing, how do we make sure we build it in a manner that enhances enterprise value over time? And the last thing, the glue to all of this is that personal tax return. These 4 documents inherently all affect what flows of that personal tax return. That personal tax return is where we find the nuggets of goodness. There are so many tax things that we start to find because of what's happening at the entity level that flows into your personal return that we can tweak. We can make sure, there's compliance issues, there's estimated tax issues. So many things happen, and that's the glue. And if we just bring all of those things together, spend time looking over them together, not scattered together, there is so much value that can be found for clients. That's all great, but you're probably wondering how does this actually then benefit? And I have a fun little case study from a client in California that we're going to walk through that kind of brings together the goals and also why these documents matter. So let's get into that. I'll caveat, there's a lot going on here. This is very specific to this person's situation. Everyone else's situation is going to be different. But the heart of this is with the right models, the right scenario modeling, so many value adds can be found. This is an S Corp owner with $1 million of allocatable profit. Now, why do I say it that way? Well, when you're an S Corp owner, you essentially receive money 2 ways. You get a reasonable comp W-2, and then the rest comes as a K-1 distribution. So I say reasonable comp because there's a lot of rules around that, and you got to make sure your W-2 is accurate and correct, but it needs to be reasonable. Okay, they're in California. This person's in California, so they're getting taxed heavily. So we added a number of strategies that created a substantial amount, about $250,000 of value here. So in this particular case, this is a client who's trying to build an operationally independent business. So the chairman of the board scenario is really what's playing out here. So at the moment we have basically it started with a $400,000 W-2. We knocked that down to $250,000 with their CPA's blessing. It's still more than reasonable. What that did was that increased their K-1 distribution by $150,000. We've just unlocked a lot of tax savings doing that. We added a profit share plan. We added the ability to write off their California state income tax. They weren't doing that before. We opened up a 401k plan, so we have a deferral that creates a deduction. But what's really neat, kind of under the hood, this is a little bit of a geeky part, but we were able to increase their QBI deduction by $17,500. We were able to lower 2 different taxes, their Medicare tax and a Social Security tax that's in California, down substantially, really about $9,000 of value just there alone. And then we're able to find a fund to start up that 401k plan. So in scenario 1, they made $1 million. They retained $565,000. That stinks. In scenario 2, they made $1 million. They retained about $800,000. That's a fairly substantial difference. Now, how's that possible? It's start with the goals, get the right documents, and start modeling scenarios. We have found that very few people have ever had scenario modeling done for them. They've never seen something like this. Is probably actually kind of overwhelming to you just looking at it, because there's elements of this that are tax related, there's elements of it that are wealth related, there's elements of it that are entity structuring related. There's a lot of layers to this. That's why you got to understand the goals, why you have to have the 5 documents. So if you're frustrated and feel like you need this type of modeling done, then schedule a time in the link in our description. I'll see you there.